On this week's episode of the Stockscores Market Minutes, we'll talk about the right time to buy weakness. I'll do my regular weekly market analysis. We'll do a market scan in search of opportunity and the trade of the week on PGNY. Okay, so when to buy weakness? It's an important concept because there's actually a lot of money to be made by buying weakness. It's sort of that contrarian view. But it's important to understand that it's not always appropriate to buy weakness. We want to buy stocks that are in upward trends that simply are pulling back to their upward trend line, or stocks that have been really selling off emotionally and get to a floor price where there is a likelihood of a bounce. And so those two concepts I'll show you on the next chart. There is a lot of potential for trading profits when you're buying weakness. But you have to be aware that you really can get crushed financially if you do it wrong. The simple idea of buying something because it seems cheap relative to its past price is not a good way to approach this. As I said, you want to look for pullbacks and longer term upward trends as prices approach the upward trend line. Or look for stocks that fall into long-term support as they often bounce there. So let's take a look at this chart because it actually has examples of both situations. So the first is the upward trend line here, and you can see that price would run away from the upward trend line, come back to it, and then sort of make a show of strength at the upward trend line, and that would be an appropriate time to buy weakness. It had been trending lower for about a month, came down to that upward trend line. I probably could have drawn that a little bit better, but at that point it would have looked more like this. And so you buy there, and then it ramps up nicely afterward. Now, if we look at the other type of trade, when you have strong support like we had there, so we see that the stock had found good support there. It ran up from support, pulled back, a little bit of emotional selling there, and when it hit support, it started to get quiet again, and so that would be an appropriate time to be a buyer of weakness as well, and then ultimately that support held, and the stock went into its upward trend. So, simple concepts. What you don't want to do is to buy stocks that are in downward trends because the trend is down. We want to find stocks that at least have that upward bias to price, and that's when we want to buy weakness. All right, let's get into this week's market analysis, starting us off with the S&P 500 30-day, 60-minute chart. A little bit of concern came into the market, and we don't really yet know why. There was a sharp downward move on Thursday. There was some Fed comments, perhaps coronavirus issues, but something touched the market off, and we had some fairly strong selling pressure all of a sudden around midday on Thursday. And that has started to materialize into more weakness. We saw some follow through come in on Friday. I think it's important to recognize that when markets run up quickly, investors are nervous. They want to take profits, or they're certainly trigger happy, dancing by the exit door, if you will. And the slightest bit of negativity can cause some quick selling by those short-term biased traders who are simply wanted to take their money and run. And so I call that the Steve Miller trade. You always have to be aware that that's going to happen. And in this case, we had a couple of days of selling pressure. It's broken this very short-term upward trend line. We still have lots of support and lots of reasons why this market is still okay, but it does feel like there's some nervousness there, and I think that we should be cognizant of that, because it could materialize into a more important longer-term trend line break. Now, when we look at the longer-term chart, and this week I've chosen to show you the 240-day daily chart, which is essentially a year, and I can draw the upward trend line like that, and we are in what we call an upward sloping channel. And the bottom of this channel is where there is support. And so if we were to pull back to the bottom of that channel, we should bounce. If we actually build a falling top like we did there, and then were to actually break down through the channel to the downside, then I would get more concerned that there's more weakness coming. So for now, it's okay. We get pullbacks and upward trends all the time. It's okay. But it only matters when the upward trend line is broken, and that's what you want to watch for on the S&P 500. Now we can also look at the more small cap stocks. This is the Russell 2000. And it has run up into some resistance. We haven't quite got to the highs, but we've come close. And a little bit of weakness on Friday, but not the kind of weakness that we saw in the broader market. And so the small caps are still hanging in there. They're not showing the same enthusiasm this year that the large caps have shown, but it's still a relatively healthy market. I'm hopeful that we will come up into this zone and then break out, and if so, you'll see those lower price stocks start to really do well. Onto the Canadian markets, and this is the TSX 60, which didn't suffer the same sort of weakness that the US markets did. And so again, I'm a little bit confused as to what's going on here in terms of what's driving that weakness. We had a little bit of, sympathy selling on Thursday and then a little bit of follow through on Friday, but that longer term upward trend is still in place. And so I remain sort of cautiously optimistic with the Canadian market. It's been doing very well, but it is due for a pullback, some profit taking, and that may be what we're seeing the start of now. Looking at that longer term chart, one issue I see here is that the trend is going a little bit parabolic. So we like to draw trend lines like this, and when price runs away from the trend line, it tends to then have to come back. And so we're running away from the trend line a little bit, and we may just correct back a little. Again, not a big concern, not this kind of a selling pressure yet, but certainly something to keep an eye on. And again, if we were to break down through that upward trend line, then we'll need to get a lot more defensive. TSX Venture, there's a little bit of bottom fishing in the cannabis stocks. Of course, the gold names, which many are listed on the TSX Venture, have been doing well. So we're starting to see some stability in this market, which has been pretty deplorable. We had a double bottom. I talked about when stocks fall into areas of support. Well, the market itself fell into that area of support from these lows, and it's bounced off of it. So this week we actually break a little flag pattern, which is a break from a rising bottom. That is a sign that the buyers are starting to gather some momentum. I think it's still early, but you may start to see more opportunities appear on the TSX Venture market. On to currencies, US dollar has made a pretty good comeback from this breakdown, which happened here. And the question now is, do we go to new highs, or will we fall short of new highs, make a falling top, and then start to gather some downside momentum? That's what you want to watch for. Do we break out through these highs? If so, this negative signal will be negated. If instead we build a falling top, like if we were to top out on Friday's high and roll over and head lower again, then we may get some more weakness in the US dollar. On the Canadian dollar side, we have fallen into support. See, we fell into support, we've fallen into support, and we bounced. And we're starting to bounce now. I think probably we're going to move back up there, but we're talking about very minor moves for the Canadian dollar. The upside potential to that level is not that significant, and so it's really a range-bound currency right now. On to interest rates, and you can see the bond market surged higher. I think there's a little bit of fear in the market, a little bit of running for cover, looking for safety, because we've seen it in the bond market. We're also going to see it in gold in a moment, and that is another reason I'm a little bit concerned about stocks. We've seen this nice rally back in the interest rate, or in the bond market, which means interest rates are going down, which implies fears of a global recession. They have to scale back interest rates or do some sort of monetary stimulus, which is why gold goes up, which is why the bond market goes up. And we'll see if that materializes into a breakout. We should stall at the highs. That's typically what happens. But yeah, it looks like the bond market ultimately wants to move higher, and therefore interest rates going lower. And on to commodities. And there's that gold chart again, the flight to safety. Investors concerned about what's happening with this coronavirus. What will be the impact on the global economy? Will central banks have to do stimulus to help the economy? And does that then devalue currency? In that scenario, people look to hide out in gold. And we've seen that happening for about a year and a half with this general upward trend. We're running away from the trend line a little bit, so getting a little overbought. I would be cautious about chasing new positions here. But if you bought on this flag break, which we talked about, a couple of months ago when the gold chart broke that flag, that was the next or the last signal to buy gold, and that is now materialized into this reward. To chase it here, you're coming late to the party. You want to buy the breaks from low volatility. That happened there, that happened there. Too late now. We'll wait for the next pullback to provide an opportunity to enter some of those gold positions. And oil, it has fallen into support. Again, this is kind of a theme. We fell into this support, bottomed out, and look at how many times it's hit that level. And again, it hit that level 2 weeks ago and has bounced off of that. Does that mean we're going to head back to the top of the range? Quite possibly. It may just rally up a little bit, make a falling top, and then ultimately break down through this level. But it does seem like oil, for the short term anyway, is stabilizing and bottoming out. And finally, the fear chart. Always like to keep an eye on the VXX. It shows that investors are buying insurance through the futures market in the S&P 500 short-term futures. And you can see we've had a little bounce in fear Thursday and Friday. That's always an inversely correlated instrument to the overall market. And so if you're looking for a way to protect yourself against a correction, this is one thing that tends to go up when the market corrects. Now, I think it's still too early. This, generally speaking, is a losing trade. Over and over again, it has these little bumps and then it falls, has a little bump and falls, has a little bump and falls. And so it's really a short-term instrument, and do not ever hold this thing long-term, especially against the trend. It's something to trade when the market is showing some nervousness, some fear, and that's why we call it the fear index. So my ratings then: US stocks bullish long-term, neutral short-term. Canadian stocks, I'm keeping my bullish on both time frames rating. Gold, bullish on both time frames. Oil, neutral long-term and neutral short-term. So while the markets continue to be in those longer-term upward trends, investors are showing this nervousness that comes with the big gains of late. And any negative news seems to bring some profit taking, so expect volatility in this environment. Until that upward trend is actually broken, I would stay bullish, but be cautious about chasing stocks higher. All right, let's do the Stockscores market scan now. So what we like to do here is look at the market scan tool on Stockscores. It is a really great filtering tool. We can go through the entire market in seconds. There are preset scans. I tend to run the abnormal break scan, which is the one that we're going to do. There's many different ones, but for these videos, it's sort of the simple one. And the idea behind this scan is looking for stocks that make an abnormal move to the upside, statistically significant abnormal price move to the upside with abnormal volume. And when we have those two things, we can perhaps see a stock that is setting up for a new upward trend. Now, the key is that it has to be from the right pattern. So I'm going to look through a few charts with you to show you why I like some patterns or why I don't like others, because that hopefully is something that's educational. So let's jump over to the market scan tool here, and we're going to select the abnormal breaks US scan this week and run the scan. And you can see that in just an instant we have found 41 stocks that made strong price moves to the upside. Many of them are in the gold area because, of course, gold was strong. We want to be cautious about chasing those gold stocks higher. Not all have participated, however. Now let's just look at this chart for an example. You can see the abnormal volume, you can see the abnormal price action, but remember the third requirement is a good chart pattern. And these are the things that I teach you to look for in the different courses that we do at Stockscores. But the issue there is it has strong resistance and therefore is likely to just hit that level and get stuck. And so when I think about probability of this working, I would say it's a 50-50 chance that this trade is going to work because of that overhead resistance. This is a little more interesting. We see again the abnormal price move and the abnormal volume. What I like here is that this stock is breaking a downward trend line. So that is our line of resistance, and it does so after the formation of a little rising bottom. My concern is that a lot of volume traded in that price range, and those people have been losing money for months. And when people are losing money for months, what they ultimately aspire to do is break even, which is why these sideways trading ranges tend to present a wall that the stock may have difficulty getting through. And so when we get back up to that 170 level, 180 level, I expect that there will be some selling pressure. So if I was to put a score on this one, of course this is Stockscores, so let's do that. I'd give it a 6 out of 10, which means I think it has a 60% chance of working. To me, that's not good enough, but if you know something about this company, you like the business, perhaps that would be something to consider. And that's always what I do, is I just look for the abnormal activity and then I assess the pattern. This one has pretty strong resistance here at just around $4, so it doesn't particularly interest me. Even though it's showing some abnormal activity, I just think there's too much potential for selling pressure. BDSI, volume not great on Friday, so even though it had the good price action, not great. And then again, quite a bit of resistance. And so be fussy as you go through these charts, be very selective about the patterns you take. And again, I can teach you what to look for, but of course, if you want to figure that out on your own, and then you can use some of these skills in assessing the charts. All right, so let's get back to our presentation for this week. And I want to look now at the day trade of the week. And again, this is always just an example of a stock that triggered my trading rules on a particular day last week. This one came up on Friday. My comments to my Active Live audience, and again, Active Live is a webinar that I do each day where people watch my trading screen or my analysis screen. And on the open on Friday, I said consider shorts or be very selective with longs, because the market was opening weak. It was breaking an upward trend line. There was a lot of indication that the market was likely to go lower. And it's always easier to trade with the market's trend. And so in this case, this was a short sell signal that came up, I don't know, maybe 10 minutes after the open, maybe 12 minutes after the open. And the pattern was a breakdown from a descending triangle. See how there's falling tops here? So that is a sign of pessimism. Now keep in mind that this is a 2-minute chart. This is Thursday's trading, and this is Friday. And then we had my action candle indicator trigger early in the day on Friday with strong volume. You can see the spike in volume there. And that tells us that there was a general running to the exit door. People were nervous. Now, if I looked at this chart anytime, I'd say, yeah, that's a pretty obvious negative signal that this stock is going to go lower. The challenge is to find these things in a timely way. And what my tools do in Active Live is that it scans the entire market in real time, looking for those stocks triggering action candles, which are abnormal price move, abnormal volume. We can look for up candles, which are buy signals, or we can look for down candles, which are short sell signals. On PGNY, for $100 of risk, you would short 220 shares. That is a $7,200 position, but you can margin when day trading 3-to-1, so it becomes a $2,400 position. Ultimately, and when I say position, I mean it's a $7,200 position, but it would require about $2,400 of capital. At the end of the day, that trade was making 6 times its risk. So for $100 of risk, that was a $620 gain. If you took $1,000 of risk, then it was a $6,200 gain. Although the pressure to get that order filled with a larger risk amount would be higher, because there's always liquidity issues in trading, of course. In this case, with that $100 of risk, it was a 25% return for a 1-day hold, trading with the trend of the market, which we always encourage. The market was moving lower. It broke down on Thursday. It followed through on Friday. And so shorts were a good place to look for opportunity on Friday. Well, that has been the Stockscores Market Minutes for February 24th, 2020. Hope that you've enjoyed it. Please click on the like button if you have. Subscribe to the channel, turn on your notification alerts, and most importantly, trade well.